Since the end of last month, we didn't change our mindset as to our asset allocation. We remain cautiously positioned and recommend an underweight in equity markets. Despite the fact that corporate earnings have come in pretty strong in the US, we believe that current market valuations do not offer enough upside to be engaged in this asset class. We shall not forget that even though the US economy is showing decent growth, the US is the only large country in the world which has not yet started to think about saving, and that will come at some stage. We are underweight equity. Do we like government bonds? The answer is no. If you look at the so-called safe haven, Swiss 10-year government bonds, yielding 0.6%, which is close to zero, or Bund, the 10-year government bond from Germany, at 1.6%. We believe these instruments do not reflect the strengths of both countries. They rather represent now a cheap insurance for investors to protect themselves from a euro breakup. So within government bonds, what we prefer is high yield, which is the universe of the high coupon bonds. And here we also like local debt from emerging markets. Let's come back to the situation in the Eurozone. We believe the situation is still complex and there is a lot of uncertainty. And we strongly urge investors to consider, especially if they are based in the Eurozone, that outside of Germany, they consider emerging debt in US dollars as a credible alternative. Within the Eurozone ex-Germany, France, Italy, and Spain represent 70%. You have deteriorating fundamentals. You have high volatility and interest rate divergence. So for conservative investors, the safe part of their portfolio is broken. If we look at the result of the elections in France and Greece, one can say the following. In France, the new president has outlined measures that are meant to boost growth. But if we look into the details, it is mere government spending and does not address, in our opinion, the fundamental problem of France, which is a loss of competitiveness versus Germany over the last 10 years. In Greece, the outcome is a mere disaster for the legacy parties, New Democracy and PASOK, and it shows to us that the ability of Greece to implement the measures which have been agreed with the Troika will be difficult to implement. One can say that with 2% of GDP of the Eurozone, Greece might leave the euro, and that should not be a problem. We beg to disagree. We believe once you start to have one member leaving the euro, you put a big question mark beginning the whole euro project. So you understood, we keep pretty high level of cash. We like cash in situations where people are relatively positive because we are able to deploy this cash when the situation worsens. And we shall not forget, central banks and authorities and governments always react when things got worse. Thank you very much for your attention.